The Fed held rate steady in their recent Fed meeting, but two governors favored cuts. And actually, just this past Friday, Jerome Powell hinted that there may be a cut. But the key is that this might be the first multi-governor opposition in 30 years. And so the minutes of their meeting show that there's a split. There's concerns between inflation and employment, plus tariff/political uncertainty, and including obviously more pressure from President Trump. So Cory, our listeners, they feel whiplash. Are the rates coming or not?
The rate cuts?
Yeah, sorry.
I think the cuts are coming because of the way, one, the Fed has telegraphed it. Two, if we just take the politics and everything out of it for a moment and just look at the data, like the bond market itself, the 2-year yield is a really good indicator of, roughly where the Fed funds rate should be. And that's been something that's well respected. I think the bond market has said that interest rates on the short end should come down a little bit. And that's why I think that's what's going to happen. I think everybody will listen to the bond market more than me or anyone else for that matter.
Yeah, that makes sense. So here's the opportunity. And again, we don't know. So the next Fed announcement will be, I believe it's September 17th. Is that right, Cory?
That's right.
Yeah. September 17th. And so the opportunity here, though, is that you want to recheck your cash positions and make sure that you're leveraging a high yield savings account. And you want to look at your cash versus your risk. So basically your cash versus stocks and bonds, and consider, like you talked about, laddering your bond portfolio, because the idea is that if you don't have your bonds laddered, and laddering is just basically staggering out the maturity dates. But if you have all of your money in a 1-year CD, or you don't have a bond ladder, what happens is when the Fed lowers rates and if bond yields go down, well, you're going to have to reinvest this money in lower yielding bonds, which is not a fun thing to typically do. So the key here is, this is education, this isn't advice, but my point is the opportunity today is to make sure that your cash is structured the way that it's supposed to be. And then if you have a bond portfolio, maybe you want to make sure that it's laddered just in case rates go down.